We are ready for our next speaker, Raed Alkhadr. He is from Equiti, and he's going to be talking about how to apply savvy risk management to the markets. So please welcome him to the stage.
Hello, everyone. This is Raed. I'm heading the research department at Equiti Global Markets. Equiti is an online brokerage firm that's taking place in multi-jurisdictions in the world, mainly in MENA, and we have our offices in Amman, Jordan, UK, London. We are existing also in Dubai, as well as a couple of licenses in Africa. We are the first regulated broker in Kenya, in Seychelles and Nigeria, as well as other offices around the world in the US and New Zealand. So basically, we are taking the opportunity of being here in such an event that's happening and taking place on a regular basis now, hopefully after the COVID-19 things and the lack of face-to-face meetings. We're back again to this nice habit, and also it's we thought that it's good to talk about a very important topic that honestly was taking ringing a lot of bells in the last year and the year before, due to the big amount of losses that I personally witnessed and my company as well, due to the wrong risk management or the ignoring of risk management. So I take the opportunity of being in this event to speak about how critical is the risk management. So first, let me speak about this component that it means profit or loss for you to continue or not in this market. One of the most important aspects of Forex trading that traders seem to be unaware of is that traders should not expect any particular trade to be winner or loser. There is no clear distribution of chances to know your trade gonna make profit or loss. It's pure statistics. You do your job, you analyze the market, you do the technical analysis, you take the recommendation, and you should leave it to something called risk management module, where you should accept whatever the result. But the sequence of those results need to lead after a time to a profit machine that making you profit on a cumulative methodology. So how this happen? Basically, it is far from important for you to effectively manage your money than continue to look for a better trading system. So first, you need to think about how to manage the risk, then what is the strategy? So I put a few of good questions for you all guys to start understanding how this happened. Essentially, money management tells you how many lots to trade at a given point. This is money management, okay? Risk management is everything you do before you take a trade. Money management is after you take the trade. So you need to precise your risk before even you take the actual trade. What does that mean? If I will tell you that 90% of your trading experience is risk management, and only 10% for two things: getting lucky and strategy to know the trend. Could you believe that? 90% risk management 10% knowing the trend or the direction of the trade. How this happen? By applying those two things. Risk management before the trade, money management after you do the trade. Issues addressed by money management. First question, how much capital do you place on each trade? Those are the questions. I am a trader, okay? Before even I be a market analyst. Let's remove all what we speak about, company, blah, blah. I'm a trader, just like you. I've been trading in this market more than 16 years so far. Those questions that you're gonna read here are questions happened with each and every one of us. Maybe at the beginning of your journey or later, but you're gonna reach to those questions. How much capital you gonna risk for each trade? What is the heat of your trading? Capital preservation versus capital appreciation. Setting stop versus setting take profits. When must you take a loss to avoid a larger losses? Let me start answering those together in a logical way. How much capital you trade? Absolutely. If I give you a gun now and I put a target in front of you and I said aim to this target and I give you 30 bullets to hit it. How many chances to hit the target? You have 30 bullets. If I give you 3 bullets, it will be less times you're gonna hit the target. Or you need to be very accurate to hit the target with 3 bullets only. Being in this market is to trade more often, not to trade less. Yet, you have to be very careful picking the high quality trades. So, I need high quality trades very often. How I can do that? By reading more products, logging on many time frames, and be available with my ready to fish my opportunity from this market. How we do this? By risking 1 to 2% on each trade only. Each trade maximum, whatever you are, let's say, how you trust your strategy and your study, and you think that you are right in your call, maximum loss for each trade, 2%. Professional traders, they might raise it sometimes to 5%, and this is gonna be too much. But remember something, the golden ratio. If you are risking 1%, you should expect at least 1.61 as a profit to stay in the game. Otherwise, because I told you, 90% risk management. Forget about all the tools, how you analyze the market, and you discover the new direction. Let's focus only on statistics, only on math. Math tells you probabilities, how to enhance the probabilities. I'm telling you, if you risk 1% on the trade, you should expect at least 1.61 on this trade. This is the only way you can success and continue. If you are risking 1 to 1, then you're gonna lose. Why? Because it's very difficult to be accurate more than 50% of the time. Yes, I'm a market analyst who study this market, who has degrees, high degrees in this market, but yet I'm not 50 to 60% right in this market. I depend on risk management because I live on continuity. I live on doing the right thing over and over and use the right ratio and high quality trades only. One thing you should always keep it in your mind while you are trading. I'm giving you the golden rules here. capital is more important than profit. Your capital is the important thing, not the profit. So always your thinking is how to protect my capital, how to efficiently use my risk, or I risk from my capital for each trade. Apparently, you are using this capital to make money out of it. So each time you are trading, you are risking in that trade certain amount. You need to be very careful by choosing the right amount for each trade. And what is the maximum exposure to the market? Yani how many open trades at the same time they might get stop loss altogether. You need to calculate this as well. To not be in the fear of margin call or stopping out or getting out. Oh my God, my trade was good, but I don't have enough margin. My call was okay, but I didn't respect the take profit. I was able to stop my losses earlier, but I removed the stop loss, or I didn't put. You are answering the questions that more than 95% of people losing for. You are the reason. We are the reason of our losses, not the market. I can say 1 to 2% is the factor value of the market versus you as a trader and as a character, how you are trading or how you are respecting or paying for the rules. Another question, if you are on a losing streak, like strike of losses, I take a trade losing, I take a trade losing, I take a trade losing. Are you going to trade the same? No? Are you going to trade the same? It's all about money management. If your strategy is saying that you have this amount to risk, 1% per trade, maximum loss drawdown is 30%, you are following your strategy. You change nothing. You change nothing. You keep doing, you keep acting, you keep throwing and waiting to fish the opportunity. It's not about you. It's about maybe the good timing of the trade, the wrong reading of the market. It could be. But it's not about the size of your trade or how risk is your trade system is. No. It's about, did you hit the maximum losses per day? Did you hit the maximum losses per week? You should be predefined rules. You have your predefined rules for your trading system. How many losing trades a day? How many losing trades a week? How many losing trades a month? What is your maximum drawdown? Even if you have a strike of losses, you need to put a maximum number of those trades. You know, those observations and those rules, they enhance your, let's say, the actions in the market, your attitude as a trader. Because it's very difficult to control ourselves. We know this. You need a cheat sheet beside you to respect the rules all the time. To remind you, okay, today I hit 3 losing trades and this is the maximum drawdown for me for a day. I will not trade even if Ben Bernanke himself telling me sell the gold right now. Or Jerome Powell or whoever. I hit my limits, I stop. Exactly the same way you respect your stop loss and take profit. The same way. Your stop loss and take profit, you put them not to drag them and play with them. They called stop loss. If I will keep moving my stop sign every time, just because I want to take more risk without any strategy behind it, there is no meaning of this stop loss, believe me. But if there is a strategy behind moving my stop loss to the entry, if I make 30% of the target, there is schools like this. Yes, then okay, I can use this. But stop loss is something that you should care about even before you take the trade. Where is my stop loss? And we will take some time to explain to you how to put and set the right stop loss, how you calculate it, and what are the ways of doing that. Then, how is volatility handled when volatility happened? I'm a trader, always asking myself, oh, it's like today is volatility, FOMC this night. What should I do? I have open trades or I'm thinking to open new trades. How you handle volatility? Do you have rules for that? Do you have risk management rules for doing volatile day, for handling a volatile day? Usually, by limiting your trades, downsizing the size of your trades, plus, very important, stop trading where there is a news. Wait the news till take a place, then do the actions. Otherwise, you are in front of the Lord. Just like, I'm going to win or lose, I don't know. We are traders. We are not gambling here. If you are going to gamble, then I recommend you go to blackjack or do roulette or have fun, man. It's like not come to this market, burn yourself with adrenaline and do not, at the end, just like you are going to 50-50. Put yourself, when the news are coming, is not a trading opportunity. I'm telling you, trade after 15 minutes, 30 minutes. Wait the hustle to come down, then go in the market. If you are a trend hunter, if you are like a strategy trader. Otherwise, like volatility could make money, could make risk at the same time. I'm running in my slides, guys. I believe 30 minutes is not enough, but it's like an opportunity to, have a little chat here and there, and always welcoming you on our booth, Equiti booth. Anytime you can come, we can discuss more details, but I'm trying to hit as much as I can from the slides that I prepared for. I'm jumping right away here to a very important question. Risk level among trend followers varies depending upon the size of the profit they seek. If you are seeking a profit of 100% a year, you should accept the fact of 30% drawdown. What is drawdown? Drawdown is the drop between a high in your portfolio equity to the low. This movement from the top to the down, they call it a drawdown. My equity was 100K, then my equity became 90K, then my drawdown is 10K in this case, okay? If you are looking for 100% return a year on your investment, you should accept the fact that you might see a drawdown of a 30%. This is not like science. This is by the numbers that we see. This is the probabilities. Most probably, you're gonna face 30% drawdown. This is by the numbers that we have. Most of our clients, world's clients, they do the same. If they are targeting 100K, 100%, 30% is most probably to happen. You need to navigate your way out of this 30%, and you need to accept the loss. Why accepting the loss? You accept the loss to avoid bigger losses. What does that mean? Cut the loss to chase the profit. So cutting losses, chase the profit is the key in this trading game. Decide the risk on each trade relative to your entire portfolio. So we said 1 to 2% is from your balance. You should put your stop loss. A reason to keep this number small is to protect yourself from a series of losses. It's okay. You lose 6 trades in a row. It's fine. There is some trading strategy built over 6 trades in row, losing, and you keep continuing. It's fine. Because it's about odds. It's about probabilities. It's not about you are right or wrong or the market is going against you. The key is to limit those losses so that you can endure a string of them and have enough capital to place trades that will be big winners, so you have the chance to be in the market later. So how to determine risk per trade? Here, it's about the position sizing. The position sizing. So how big is my position is defining what is the losing percentage. So for example, if you are selling gold, okay, and you are saying that I want to sell gold and my risk is $200. This is called financial stop loss. Financial stop loss as a percentage from what I own. I have $5,000. This is my account size, and I'm willing to lose for this trade only $200. What does that mean? If I took one lot on gold, it means $2 the gold go down, I hit my stop loss. But does that $2 is good number from technical point of view, from trading, from product point of view? No. Why? Because it's very close. $2 is very close. So what I have to play with the size of my trade to give myself a bigger breath. So instead of putting my stop loss at, let's say, 1798, while I'm entering the market at 1800, I can push it $5 down or $6 down, okay? Or $8 down. It will gonna be 1792. In this case, my trade size, it will go down from 1 to 0.2. In this case, I can stay in the market because the product plus the financial stop loss together, they form my stop loss. So I respect the 2%, and at the same time, I respect the nature of this product, how it is moving. So for gold, $2 is not enough. We need $8 minimum to protect ourselves during a day trading. Plus, we respect the size of loss per trade, which is not less or not more than 2%. A lot of stuff, but quickly I want to hint about 2 things. So the trading account, you see the drawdowns. The drawdown is the distance between the top and the low. The top and the low is a drawdown. So we start from top, we go to down. This is a drawdown by equity. Here, number of trades. Here, the trading account as equity. So this is how we see. Drawdown should be limited, should be short. So the game here, I'm playing on risk management only, ignoring everything else, focusing only on building a strategy that we use for risk management. Let me introduce 3 strategies that I can speak to you whenever you want, guys, on my booth. Those 3 strategies: short selling as a hedge to a physical investment, negative averaging strategy, and multi-angle strategy. I built those 3 strategies. It's like very doable, very achievable. You can do them as a normal trader. Those 3 strategies, I'm happy to help you on our booth to explain more about each one of them in details. And I want just to tell you that the last one, which is the multi-angle, is just like a developed strategy that already written in books that we add to it, that it's depend on dividing your capital into pieces, and each piece you're gonna lose after certain amount of strike losing trades in row. So for example, let's say you divided your capital into 20 pieces. Each piece, you lose it after 7 trades losing in row. Each trade losing, you double the size in the trade after. The concept here, it's about the quality of the trade, to choose high quality by better ratio, plus respecting the sequence of your losing trades. I'm happy to send this presentation to all of you. Whenever you want, you can visit us on the booth. I know it's very limited, 30 minutes, a quick, let's say, takes we take here. I would like to thank you, everyone, for attending this session. Hoping to see you soon, visiting us on the booth, as well in our offices in Dubai. Thank you so much. Appreciate it.